Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Today's episode forms half of a duo of special podcasts released simultaneously that are looking to summarise the 1/1 reinsurance renewals. In previous years, I've compiled these interviews into a documentary-style episode to work as a précis, but this year I enjoyed my interactions so much that I really didn't want to be chopping them up into clips. Both my guests will be familiar to regular listeners, and they both bring very different, very complementary qualities. For a full picture of the renewal and the current state of the reinsurance market, I highly recommend you listen to both. This episode is with David Flandro, Head of Industry Analysis and Strategic Advisory at Howden Re. David has a deep analytical background, but is someone who, in his long career, has not, as far as I'm aware, had to broker and place a risk in anger. The other episode, episode 238, is with James Vickers, Chairman of Gallagher Re International, who has been at the forefront of the reinsurance broking world for over 40 years. With James, I'll be getting more into the detail of the cut and thrust of the annual duel between clients' wants and reinsurers' red lines, and ascertaining this highly experienced broker's feel for today's marketplace. But let's get back to this podcast guest, David. In this lively discussion, we examine all the macro factors washing across the reinsurance market in great detail. A listen will be a great education on how the best analysts gain their understanding of the market, and will give you a good idea of where we are now and where we might be heading in 2025, provided external events don't blow us off course. David may be one of the smartest people in our business, but he's also great fun to spend time with. He's so good at explaining complicated ideas about the fundamental capital building blocks of insurance and reinsurance, and the factors that affect them, that he always makes me feel a lot smarter for having spent time with him. Howden Re has published an extremely detailed and comprehensive report full of insights entitled Past the Pricing Peak. I highly recommend reading this as an accompaniment to this podcast. A link will be in the notes. We've got a lot to get through, so let's get on with the show. Enjoy the podcast. David.
Mark.
Welcome to the Voice of Insurance again.
Thank you for having me. And I wanted to say, I don't know if you're going to include this in the podcast, but I wanted to say thank you. I think that I was guest number 3 on Voice of Insurance.
We're on about 243 now or something.
So thank you for giving us a voice, even when we were a lot smaller. I really appreciate it.
Well, I think you can't have the Voice of Insurance without voices, and you're a big voice.
Well, thank you.
Even if Howden was 5 times smaller then.
Well, much bigger and better things to come, no doubt.
So we're here to talk about the 1/1 reinsurance renewals, but hopefully a few other things as well.
Great.
But anyway, how would you describe them?
The 1/1 reinsurance renewals this year were very interesting, and I can walk through all the detail, and we will. We've published an 80-page report, which is a real deep dive into reinsurance renewals as well as commercial insurance renewals. But I think that you really need to start the narrative of 1/1, believe it or not, a couple of years ago, because we've been through the most capital volatility that we've seen in the sector probably since the financial crisis, and we're just coming out of that. So, of course, you can't really talk about 1/1/25 without talking about 1/1/23. At 1/1/23, property catastrophe risk-adjusted reinsurance rates online went up by 37%. They went up by 3% the next year. And this year they've come down on a risk-adjusted basis by 8%. But it's really important to note that we're coming off of a very high high. In fact, by our measure, 1/1/23 was the highest level of risk-adjusted property catastrophe pricing since the advent of CAT modeling. So that's what we're coming out of.
It was the highest of all time, so even post-Andrew.
That's right. Well, our property CAT index is measured using exposure in the denominator, which is a little different. But if you do it that way and you try to, it's not a like-for-like premium index, which is based on limit. It's exposure in the denominator. If you measure risk-adjusted rates online that way, then yes, 1/1/23 was the peak. But this year at 1/1 was really marked by the first general decline in reinsurance rates, and this is important, reinsurance rates across the piece since 1/1/17. So if you look at everything, property, casualty, specialty, and you take the average, this was the first time in about 6 or 7 years that we've seen rates decline. They had gone up very marginally post-Irma. They went up marginally during the initial part of COVID. They went up rapidly in 2022 and 2023. This is the first time that they've started to come down, and that is a shift. So the title of the report is Past the Pricing Peak. It doesn't mean we're past the capital trough, or which I think we are, or past the terms and conditions peak, which is also moderating, but we are past the pricing peak. And it really is down to increased capacity and more competition driving prices down, especially in loss-free property programs.
Well, 123 was kind of the perfect storm because we also had that mark-to-market loss of notional capital, i.e. we had interest rates suddenly going up and reinsurers are therefore losing capital, having to mark-to-market on their bond holdings. And at the same time following another heavy loss year with Hurricane Ian. So it was kind of the perfect storm. This is a way of saying the storm's over? Interest rates normalizing, getting decent investment returns, a little bit of gains now that the interest rates are coming off. Some of them, obviously, bond yields are a bit different. But it seems like everything's pretty fair. And then now the rate was sorted out. And, of course, the retention levels were all good. So it sounds like the market's being pretty logical then, saying, yeah, I want more of this, but I understand, every time I want more of something, I have to give a little to get it.
Sure. So I would be loath to say that the storm is over. And in fact, this is really important. The story in 2024 arguably wasn't just about cat, although secondary perils played a very big role. It was about the geopolitical environment that we're in, with all of the elections, all the political violence. And then if you think about the yield curve, the yield steepening, the potential persistence of inflation, central banking actions, all of those things together have really coalesced to maintain this feeling of heightened risk premia. And if you throw hurricanes Milton and Helene into that mix, even though they weren't as big as they could have been, there is this looming shadow behind us where we all know that
it was a good reminder, wasn't it? It's just a few degrees north and hit North Tampa, and that was it.
Exactly. So I wouldn't say that the storm is over, but we have perhaps had a bit of a random lull in the storm, and things have changed, and we are now beyond the peak, certainly of 1/1/23.
It's a feeling that reinsurers must have had. They were happier. They had more of an appetite. They were feeling hungry.
That's right. There was more capital supply. And capital supply is such an interesting topic.
How did it balance out in terms of, presumably there was a bit more demand as well because of inflation and other things?
Oh, yeah, it was robust. So this topic of supply and demand is so interesting. We can measure dedicated reinsurance capital, and we do. We think that there are now $463 billion of dedicated reinsurance capital in the market. That's an increase of 10%. That's been supported by growth in asset values for traditional carriers, but it's also, we've had a net gross ILS issuance year. The ILW market has gotten a lot bigger this year.
And what about retained profit, presumably, as well?
That's right. So retained earnings have helped a lot. We've had some of it dividended out, but the economic value add that's being created by reinsurers, that's the return on invested capital minus the WACC, it remains at or near long-term highs. So there's lots of capital supply in the market, but demand is really robust too. And this is another interesting question. Demand for reinsurance, actually, when you zoom out, it's a function of catastrophe experience, it's a function of reinsurance supply, but really it's a function of your cost of equity, and it's a function of your cost of debt and how those two things interact with your cost of reinsurance if you're a cedent. And if you can look behind the headlines, you'll see that the cost of equity for reinsurers actually has been going down, and for cedents has been going down this year as we've seen insurance shares and reinsurance shares go up on an equal weighted basis and achieve positive alpha against an equal weighted MSCI. So the cost of equity is coming down, but the cost of debt, depending on where you are in the yield curve, might be going up, and it might go up more. And we've seen record debt issuance from corporates in 2024. That's another dynamic. And then you compare that with reinsurance, which is a form of contingent capital. It really ought to be right there in the WACC formula alongside the cost of equity and the cost of debt. And we're now starting to see that fall. But it's the interplay between all those different parts of the capital structure that influence the cost of reinsurance at a high level. Now, if you want to talk about Hurricanes Helene, Hurricane Milton, what happened with capital flows mid-year versus the end of the year, those are other questions, but they all exist within that interplay of the different forms of capital of which reinsurance is one.
To hard numbers, then, demand was up, but supply was up by more, right?
Exactly.
Which is what resulted in this 8% price decline.
I think that's right. And if you look in our report at the chart that we've published about dedicated capital, you can see, actually, it's quite a dramatic chart. You can see reinsurance premiums, which we can actually measure with very precise accuracy. You can see them increasing by about 7%, and then you can see the dedicated capital increasing by about 10%. Now, that's really different to what happened in 2022. 2023 was kind of finely balanced, and we were all told to avoid using the word equilibrium, but it was relatively finely balanced. 2024, supply seems to be exceeding demand, and it's not a surprise that prices are going down as a result.
Kickstart your 2025 by attending TinTech London Market and supercharge your digital transformation and operational efficiency.
TinTech London Market allows you to explore the latest developments, innovations, and use cases for technology, Gen AI, and analytics in the London market.
And it's not just about the tech, it's about people, process, and technology.
You'll discover insights on developing successful change, building a high-performance culture, and successful implementation of emerging technology.
Join thought leaders and industry experts at the #1 technology strategy and innovation event for the London market.
Search TinTech London Market to discover the full agenda and speaker lineup.
Now we're past the peak. A defensive reinsurer will say, well, I want this to become a plateau now.
Yeah.
How likely are they to get the plateau that they would like to want? They would like to say, I want to defend this position for as long as I possibly can. How long do you think they can hold?
Well, the answer to this question has a really big standard deviation around it because it all comes down to events, dear boy, events. If you look at the index that we were talking about earlier, the Global Risk-Adjusted Property Catastrophe Reinsurance Index, if you look at that index in our report, you can actually see that the lows are higher and the highs are higher.
I was looking at that as if that was a stock chart. I'd say this is a bull market.
Yeah.
This is going back all the way to 1992. So, well, it's got higher highs and higher lows, and that hasn't been broken, so the trend is upwards.
Yeah, so then...
Is that just reflective of loss cost?
It's reflective of a whole bunch of different things. I mean, it's...
Because we know we've been having more catastrophes. I mean, very consistently, we're over 100 billion average every year, it seems. And it seems the probability of a 200 or a 300 or a 400... it seems to be going up all the time.
As I say, that's always looming in the back of one's mind. But if you think about it, if you look at history as a guide, the last time we had a peak anywhere near this was 1/1/2006. And we did stay elevated for quite a few years after that. But you'll remember just as well as me, the credit crunch, the financial crisis, Ike, Gustav. We had Christchurch, Canterbury, Tohoku, Fukushima, Sandy. So events, dear boy, events intervened, and we had this plateau. It wasn't as high as the peak of 1/1/06, but we had capital entering the market, both in the form of sidecars, new startups, and all that stuff. It wasn't until we got the massive quantitative easing post the Eurozone debt crisis, where we got disinflation, that we saw the very rapid and dramatic decrease in reinsurance rates online. And then you can see them picking up rapidly in 2022. And I think actually it's really important to note, last time we were in a very soft market in the teens, we were in a disinflationary environment where you actually had to pay the Germans to take your money, right? It was a negative interest rate environment.
You had to pay the bank, didn't you? Yeah.
Exactly. We're not in that environment anymore. The risk-free rate has reasserted itself, and now you can get 4.5% on your money market in spite of some recent easing. That will, ceteris paribus, put a floor under everything, including reinsurance pricing.
Will that increase appetite? And we'll get back, because it's been such a long time since any of us remembered that reinsurers used to be able to write to, 105 and make plenty of money. And whatever it was, I mean, you used to know that formula off by heart.
It was 103.5, and you get 6% investment return, including harvesting, lever net technical reserves to equity 3.5 to 1, and you get a 12 ROE. But ROE, Mark, isn't enough, because ROE is just measuring your return on equity. It's not measuring your return on equity and debt, and it doesn't measure that relative to your cost of capital. The thing that does that is called economic value add, and that's what we have in our report. And it's notable that the economic value add of reinsurers, particularly in Bermuda, but also in London and elsewhere, is higher than it's been for a very long time. And that is commensurate with heightening reinsurance share prices and a lower cost of equity, because you have a cheaper cost of issuing equity if your equity is more expensive. So anyway, all of that together means that we are actually at a profit peak for the cycle. And the water is still warm. It's still fine. I think that 2023, as we've said before, was the golden year, if you will. The end of 2022 would have been the optimal time to invest. That was when everyone was fearful. An astute investor would have been greedy. But rates remain very elevated, and we now have a couple of years of loss experience pursuant to the terms and conditions set at 1/1/23 to prove it. And the capital is now starting to come in. And it's not just coming in through secondary public offerings and debt issuances. It's coming in through the ILW market, through the ILS market. It's coming in through the MGA market, into the ENS market. It's an increase in capital supply through all of those channels, including the moderation of interest rates, which is driving traditional capital higher.
And retain profit.
Exactly. And it's because reinsurers have experienced profitable growth that supply is coming back in.
Just to quickly get Milton and Helene out of the way.
Okay.
Did they really make any impact?
They did. They did make an impact, and we shouldn't brush them off, even though they weren't as big as they could have been. I had the great fortune to be in Bermuda when Milton was approaching Tampa with my colleagues there, and it was the first time that I got to sit with Howden Re Bermuda when something big was happening. And my goodness, it was a trading floor environment. Our brokers had gamed out 5 or 6 different scenarios for Milton fully. We were monitoring very carefully what would happen if Milton made a direct hit on Tampa. What happens if it veers left? What happens if it veers right? The worst case scenario for Milton was quite something. Now, thank heavens, the worst case scenario didn't materialize. It could have been a lot worse. It was still terrible for the people involved, and Helene was particularly awful for those involved, including in North Carolina. But the actual insured loss amounts, both because of the storm trajectories and also because of insurance availability and reinsurance attachment points, meant that the ultimate losses are going to be lower than they could have been. But as I said earlier, the close call creates a looming concern about insured cat risk. And as you pointed out earlier, a normal loss year is now well north of $100 billion. 10 years ago, we would have maybe laughed to hear somebody say that. But that means that if a normal loss year is well north of $100 billion, what is an outstanding loss year? It could be $200 or $300 billion, and that's always in the backs of the minds of underwriters. So in that sense, Milton and Helene actually had a dampening effect where they could have had a strengthening effect, but everybody knows they could have had a strengthening effect in terms of rate. So I don't think that they had no effect.
And in terms of demand, there's another good reminder, this is what reinsurance is for. It's to protect my capital ultimately.
Yep.
What's your final score on demand? Have you been able to measure dedicated reinsurance capital, so effective measure of proxy for supply? Mm-hmm. What about demand?
Well, demand was robust. Like I said, premiums rose to $433 billion, and we can measure that very accurately. And then if you zoom out even further and look at commercial insurance, one of the remarkable things about this renewal is that exposure-driven premiums increased for the first time since 2019. What does that mean? It means that exposure grew. Reinsurance exposure, insurance exposure, loss penetration, insurance penetration, all of that grew in 2024 for the first time since 2019. Most of the premium growth since 2019 has been driven by price. So when you measure it by exposure, yes, there was more demand in 2024 actually than there had been since 2019. And that's because prices moderated a little bit, but also because reinsurance is again becoming a more competitive form of capital, particularly contingent capital, and particularly in the tail compared to other forms of capital.
Now we've got this slightly more pliant market, or let's say a market where supply has appetite and wants to do more business. The big story of the last 2 years has been the resetting of retention levels for cedents.
Yeah.
So that reinsurers have, even with this 100 billion a year, they've not been really been picking up the percentage of losses that they would have done before. I remember you had a really good chart on that, probably one of your last reports anyway, but I'll have links to all of those.
Thank you.
You've been demonstrating that reinsurers have not been picking up as much as they would have done back in 2017,
right?
Where they're nowhere near those sort of low retention levels, where they would pick up nearly every other secondary peril as well.
Yeah.
Now that we've got the appetite back, this has got to be your opportunity to finally get your clients some of the things they've wanted but haven't been able to get the last couple of years.
Absolutely. We've been working very hard to do that because we think that actually that would be very positive for the partnership between reinsurers and cedents. And as I said, it's very clear that there's a strong demand for reinsurance. I think if you're a reinsurer, your balance sheet is just incredibly valuable to your clients right now. And our job as brokers is to make sure that everybody gets the optimal outcome, particularly clients. But let me just say this. The analysis that you're referencing there was an analysis that was undertaken by our CAT analytics team a couple of years ago. And in broad strokes, traditionally, between 2020 and 2022, at 1/1, reinsurers assumed about 46% of all modeled CAT losses. Okay, this is coming out of our layer simulation tool, TigerEye. Cedents retained 54%. By 1/1/23, and in fact further into 2023, we got all the way down to 67-33. That was quite extraordinary.
Where are we sitting now on this balance? Is it tipping back up again?
I don't have the exact numbers, and I won't have them for a few more weeks.
It's going up again.
It has moderated again. But again, it hasn't got back anywhere near 54-46. There's still quite a long way to go. Many reinsurers would argue that 54-46 is probably too close, and that's why rates needed to go up. But those retentions got up to an all-time high.
Is it more that the reinsurers are happier to give price off
Yes.
but not go back down again.
I think it's fair to say broadly, and if we're talking across all business classes,
I'm happy, and actually I don't mind. Okay, I'd rather not, but I have to give a little bit and not to get signed down, etc. I'll take that.
there was some moderation in terms and conditions if you want to block and tackle and go line by line, but it was much less than the moderation in price in aggregate, I would say.
We've had such a great couple of years for ILS. Is that partly it? The ILS obviously loving that remote risk, the really big, the excess of 50 billion type US landfalling hurricane type layers. They've had such a good couple of years. Has that affected these higher layer?
It has, absolutely, yes.
In terms of their appetite, that they've got the appetite.
They do now. They didn't necessarily mid-year, actually, because after we got that big hurricane forecast, I think it was in April or May, the ILS market was still a little shy at 1.6, for example, but we have a record gross new issuance year in 2024, 17.5 billion of new ILS issuance. Of that, 4.4 billion was net new ILS issuance, which was almost a record, but the record for net new ILS issuance was 2023 with 7 billion. Okay, we had 3.8 billion of maturities of ILS in the second half of 2024, which was extraordinary in and of itself, and we filled all of them. So clearly there's appetite from the ILS market for these higher layers.
Once the cedent has the option to say, well, if I don't really like the traditional reinsurance market, it's nice to know that you've got the option that actually it might be cheaper to do a cat bond.
At the very high layers, yes. If you know the capacity is available, there's a lot of interplay depending on program, exposure, cedent, etc. But broadly, yes, that's true.
So it's right to say it is affecting the balance of the market. It's bringing greater competition at that higher attachment layer.
From Econ 101, pricing is always driven at the margin, and that is the margin, and it's going down.
But in general, most of those terms and conditions, in terms of that pure retention level, we're holding.
By and large, yes. I would say by and large more so than global risk-adjusted blended property cat pricing being down 8%. I think terms and conditions across the piece would have been a little more robust.
If someone wanted earnings protection, do you think they could get it?
Yes.
I think 2 years ago, they couldn't have got anything.
That's right. And so this gets us on to another topic, which I think is really important, which is innovation. And this is a shift in the market now with rates coming off. And it is really important for intermediaries like us and for underwriters to think about innovation. Because if we are going into, if you will, hard market softening, then the way to grow exposure is through innovation. So there are a lot of different and creative products that are coming online now. For example, aggregate covers where you can securitize whole account cover into the bond market or with, for example, a bank. These types of deals that are coming to the fore are becoming more commonplace and we're seeing more volume. Traditional cover is obviously very much sought after, particularly in working layers. And traditional reinsurers can still often set their terms depending on cedent program in the working layers. And then at the high layers, you have lots of ILS capacity, including collateralized and cat bonds. So it's just a plethora of solutions that's coming to the market. And we haven't even started talking yet about the primary market with the explosion of the MGA market, the E&S market. It is all about finding new, creative, innovative channels for supply to come in to meet demand. That is going to be the theme of this next phase of the market cycle, without a doubt.
Well, actually, to be fair, how much of that MGA boom has been reinsurance fuel?
The MGA market in particular, but also if you want to talk about reciprocals, if you want to talk about whole account cover that's securitized or even backed by traditional reinsurers, they offer a new channel for reinsurers to come in, for example, to the U.S. admitted market, where they haven't played as much recently, given those changes in attachment points. Capital providers, which include reinsurers, can be much more precise and much more selective in the MGA market than perhaps they could have been if this is 20 years ago and you wanted to go into the, Canadian motor market or something. You had to make a 10-year commitment. That is changing now, and that capital flexibility, that liquidity should be a good thing. But it isn't just reinsurers that are playing there. It's also investors. It's also people who provide capital for other forms of reinsurance that are non-traditional coming in. And so I think that that's true. It does provide a channel for reinsurers to come back in via that channel, but they are coming in alongside other capital providers depending on who has the appetite.
So this innovation sounds really interesting, and particularly that debt structuring, that's really, really interesting. And there the capital is not necessarily traditional reinsurance capital.
That's right, and particularly in the reciprocal market. And this is something that's been increasingly explored by my colleagues in Howden Capital Markets and Advisory, HCMA. Setting up reciprocals where there is a dearth of capacity is a great solution for people who need cover, and then as a method by which you can actually do that with reinsurance or with collateralized reinsurance if necessary.
What do you think is the outlook for mid-year renewals, April and then mid-year?
Whenever I get these forward-looking questions, I always have to go back to my refrain of events, dear boy, events. Assuming a normal insured cat loss year, which I guess these days is close to $150 billion, assuming relatively plain vanilla losses and a moderating geopolitical environment, then we could actually see rates and terms and conditions moderate further in most, perhaps not all lines. But that is
a lot, isn't it?
Yeah, that's a lot of ifs, isn't it? It's a lot of ifs. And I think that one of the things that needs to be considered as well, because we don't talk about macro enough, and you'll see in our report there's a big focus on macro, is inflation. And so if you look closely post-2021 at inflation expectations, they have been uniformly wrong at every point. Seriously, the team transitory in 2022 was clearly wrong. Inflation got up really high. Cumulatively, we're now much higher than we were then. And expectations for inflation to fall have been not materializing as quickly as economists predicted. So the real question, I think, again, it's kind of a boring macroeconomic answer, but what if inflation bears its head again for whatever reason, whether it's a trade war, whether it's supply chain issues, whether central banks simply ease too quickly? That will actually have a big effect on capital, capacity, supply, and pricing. So that's a variable that we can watch.
You haven't had a stock market correction for ages.
That's
we could
right.
easily have quite a violent one because just prices are so crazily high at the moment. Obviously, that would notionally increase the cost of equity, wouldn't it?
We had a little violence in 2022, but it was temporary, and everything pulled to par subsequently. So if
the US stock market fell 30%, it wouldn't be abnormal. It's just it would scare the hell out of a lot of people.
It would be perfectly normal, and you're touching on something really important, which is that we spend so much time talking about the underwriting side of the balance sheet in reinsurance. We don't spend enough time talking about the asset and investment side, which is really what drives a lot of capital and capacity.
Mood, certainly.
Correct. For the reinsurance sector, it's mostly the bond market. It's mostly short, medium duration fixed income securities. But yeah, if we have another bout of strengthening for any reason, then that could affect capital. As it happens, that's not happening right now. Right now, we're experiencing yield steepening, which means that the long end of the curve is showing us more risk and perhaps more opportunity long term, and the short end of the curve is moderating, and that's driving asset values higher, but there's no guarantee that that will persist.
I want to ask you about the balance between property and casualty, the appetite for risk. Obviously, that's been waxing and waning and changing quite a lot recently. Certainly, I suppose, anecdotally, over the last year, reinsurers have been more concerned about casualty because of a lot of strengthening and other things on back years, and obviously worries about continuing loss trend, particularly in the US, US court awards, that kind of thing. How did it work out? If there was going to be a hard segment within this overall softening, it would be casualty somewhere in probably US general liability, that sort of place.
Correct.
Say this might be a little hard nugget within this generally softening pudding that we've got. How did it actually work out?
I'm just brimming with things to say about this, Mark, so I'll try to make this as concise as I possibly can. Actually, at 1/1/23, there was more of an appetite for casualty than property because everybody was really still concerned in the wake of Hurricane Ian, and they were particularly concerned about the capacity shortages. That changed by Monte Carlo of 2023. The worries around PFAS, litigation, social inflation, and all of the lines of business, commercial auto liability, general liability, reinsurance liability in the U.S. were coming to the fore. I don't think that all of those concerns actually played through at the 1/1 renewal. I think that we probably saw a little bit more moderation and less hardening in terms of rate or terms and conditions, even in the U.S., than may have been expected. However, it's really important here to distinguish a few things when you're looking at casualty. The first is the dichotomy between the United States and the rest of the world, and that's really important. The second is actually there are three very specific business lines in the U.S. There's other liability, like I mentioned, reinsurance liability, and commercial auto liability. And those are areas where whether you look at accident years 13 to 19 or 16 to 19, or even if you look after 2020, there's a lot of work to be done. And there's a lot of surgical analysis going on around those accident years. However, if you look at comp is quite redundant even in the U.S., perhaps especially in the U.S. And if you look at anything remotely short tail, then it still seems quite redundant. So what the net effect of all that, and I realize that this is a very blunt instrument analysis, the net effect is that we continue to see redundancies on a calendar year basis, both in the U.S. and worldwide. You can argue that some of those redundancies have declined, and if you isolate the U.S. specifically to the Schedule P, everything looks really evenly balanced now in terms of calendar year. But if you zoom out and do a worldwide composite, of reserve development, it's still a source of profitability, totally a source of profitability for the global insurance sector. Now, my first experience in insurance was actually at an investment bank here in London over 20 years ago during the liability crisis. And I can remember all of the companies that went into runoff. I can remember opening the yellow book and looking at the A&E schedules and the reserves. This is not that. It is, however, a change to what we experienced in the teens, which was just ever-increasing redundancies due to disinflation. That period is over, and I think that what's happening here is that we're just experiencing a normal cycle. I don't believe it's a crisis. Now, the dangerous thing about casualty is that you can always be proved wrong. Bad years get worse, good years get better, etc. But I think that that theme played through at 1/1. I think that we experienced some pressure on seeds, particularly in the U.S., but outside of the U.S., we saw some give. Our London market casualty excess of loss index is down marginally, not a lot, but it is down. In the U.S., it's so differentiated that it's kind of hard to give a number. I mean, casualty is such a giant class of business if you think about it. So in general terms, I think casualty, if you will, has provided some ballast in some reinsurer portfolios, but there's a lot of concern about 13 to 19, 16 to 19, and even more recent accident years.
Presumably also students have been telling a good story to reinsurers. Said, well, look at my inwards book. This book is better underwritten year on year. Look at my rate increases. Look at the way I'm deploying this limit, and look at the underlying deductibles, etc. Everything is better than it was before. We know that the trend's bad, but I suppose that presumably they had a good hearing there. That at least they're on the same page. It's not as if the cedents are saying, "Hey, everything's great," and the reinsurer saying, "Oh no, I think I'm a bit cautious." They were both in agreement. When they were both frantically re-underwriting their books at the same time, and so there was no kind of discord.
I don't think so. As you know, I'm not a placing broker, so I want to tread carefully here because every situation is different. But we have two competing forces happening. On the one hand, there's this anecdote in our report. I'll just read it. One reinsurer's remark about the necessity of portfolio-by-portfolio surgery underscored the granular approach required to manage these risks effectively. So you have that going on one side. On the other side, as you say, you have a lot of re-underwriting going on. And then if you zoom out, which I am prone to do, and you look at the trends this time versus the liability crisis, and I know that this is, again, a 50,000-foot analysis, but first-year percentage IBNRs. I know it's simplistic. The thing about 2002 and 2003 is that we didn't start increasing first-year percentage IBNRs until it was just painfully evident that prices were way too low and reserves, particularly comp, but also everything else, was really deficient. This time, the first-year percentage IBNRs start increasing in the early 20s. And that re-underwriting that you're describing has mitigated some of the pain that perhaps, had we been a lot less responsible, could have been worse. Again, casualty is dangerous. Reserves are the thing that kill 60% of insurance companies that go into runoff, so I don't want to be flippant here. But it does not look to me like the calendar years 2001 to 2005, say.
You reminded me of the big takeaways from every time I read the AM Best impairment study, whenever it comes out. I think it was on recently. It was always sort of what kills insurance companies is they grow too fast and they don't reserve enough.
I should have cited AM Best there. That is their number, and I am just remembering it.
That has never changed.
It's just always there, yeah. And of course, that makes sense.
So would it be fair to say that actually the industry, insurance and reinsurance, is it fair to say that we have better, faster information and therefore we can re-underwrite quicker than we used to?
I think that's part of it, for sure.
That sounds like that's just a really good way of getting your fingers burned, of course, by saying
No, I think that's right. And I am afraid that if you ask the ultimate policyholders, they would tell you that casualty insurance and reinsurance, not least D&O and other areas, is more expensive than it was 20 years ago in real terms. The other thing is just fear. So there are still enough people like you and me around who are old enough to remember the liability crisis, and we calculate in real terms that the liability crisis cost between $200 and $250 billion, which is massive. So people remember that. I won't list all the companies that I analyzed back then that went into runoff because of the liability crisis. I just think that because of that, at the first whiff of a change in that previous redundancy cycle, underwriters became very careful. The other thing that happened last time around was cash flow underwriting. And going back to the equation that we discussed, back in the 90s, underwriters were thinking, look, as you said, Mark, I can still make plenty of money even if I go above 100 combined because I can get a 6% investment return and everything's buoyant, etc. We are now in an environment with a 4 to 4.5% risk-free rate, with buoyant equity markets and all of those same things. But I don't think underwriters are being told to write to 100 or anything close to that. I think it's just pure underwriting focus. And if you will, that investment yield discussion hasn't yet infected underwriting.
This free ride investment income has not entered anyone's psychology yet.
Maybe at the CFO, CEO level when they're talking to the investors, but when they're talking to the underwriters, no.
Presumably when we're talking about setting your bonus targets and that kind of stuff, it's going to be, well, I want you to get under 90.
If you go around Lloyd's and just talk to any underwriter and ask them that question, which I have, hey, does your boss tell you to think about investment income as part of the overall profitability? I haven't found anyone who has said yes. And I think that you would have found people that would have been considering that 20, 30 years ago.
That's absolutely the case. Is there anything else you think we should talk about that we haven't spoken about yet, David?
There are a few other things that are worth discussing. I mean, the continued dominance of non-peak cat losses and the implications for portfolio diversification. You might remember you and I 10, 15 years ago, we used to very comfortably talk about Japanese quake, California quake, North Atlantic Basin wind, European flood, and metropolitan terror, the 5 peak perils. I think we now call these the so-called peak perils because we have all these other things. We've got wildfire, that's a big one, but also severe convective storm, not to mention terror and cyber. So it is the plethora of loss classes and the diversification of losses that's really starting to play a big role. We've talked a lot about the expansion of MGAs and the E&S markets, including in casualty. There's a real demand for bespoke solutions given capacity constraints.
Just on peaks not being so peak, isn't that a good thing?
Well,
it's good for diversification, isn't it? You ride all of it, and they're all mutually exclusive, we hope, and therefore that's better for your capital, isn't it? It's more efficient.
I think that would be...
You can do it all cheaper, can't you?
I'm sure that would be unquestioningly true if none of the losses were getting bigger. But alas, the peak losses themselves appear to be getting bigger in real terms, supplemented by all these non-peak losses. So I'll invoke my dearly departed mentor, Chris Klein, and say some of this might be diversification. Attritional losses, they're no longer, if you will, ancillary. They're quite primary. And that's a change. And it's something that we've been dealing with really for the last 5 years at least, probably the last 7 years.
We should be getting a better handle of them. Much more investment has gone into modeling them, getting a handle on where this balance should be, where they should be retained and where not.
Correct. And this is another reason for the difficulty in obtaining aggregate cover, in addition to rate hardening over the last few years. So that's one point that I think that needs a lot of focus and a lot of research. As you know, our CAT analytics team dive deeply into this topic every day. We've already talked about the expansion of MGAs and the E&S markets. The thing that I would just like to talk about, because I think I'm a believer in disruptive innovation. And as you know, from the entire time that we've been speaking, I think that there is some scope, and we think that 25% of all dedicated reinsurance capital now is taken up in the ILS, collateralized, and ILW markets. A huge contrast to 20 years ago when it was single-digit percentages. There is scope, and we're sitting here in London with Lloyd's of London, which arguably has the best data anywhere outside of an insurance company, but within an insurance market, around different classes of business, rates online and losses online. I just think that at some point somebody's going to create a notional underlying loss ratio or a notional underlying pricing index, and people will start trading risk, at least very plain vanilla risk, against that. We're already seeing something akin to this in the follow market, and having lived through the commoditization of equity markets, barely, I think that this is going to come for the reinsurance market at some point. So that's another thing that I'm always focused on.
I haven't heard that for a long time. That's been something we probably would have talked about just about 10 years ago, the last time we had that discussion. In fact, probably that discussion was being had at Lloyd's up on the 12th floor.
Yes, I was remember that.
Being party some of those discussions
Me too.
Different times.
And we always used to say, well, people would say, David, listen, the reinsurance market really isn't like the equities market or the commodities market. It's not like you're trading a plain vanilla commodity like rubber or something, or even equities. They're all quite the same, or even standardized options are the same. It's true. The diversity and complexity of reinsurance contracts is far greater. But with AI, I think some of the younger, smarter folks might do it maybe even before the end of my career.
The consequence of that would be a smoother market, because it's effectively you're buying an option on, you're sort of smoothing out. It will help smooth out the cycle.
Yes, with more basis risk, obviously, for the, if you will, risk carrier. But yes, it would create more liquidity in the market, which is something that could be very helpful. I don't think that the big complex risks are ever going to be placed that way, just as big investment banking deals are still very much bespoke.
This is but right at the capital market end of insurance, isn't
Yeah,
it?
I think
It's
that's
to
right.
say, well, there's a very big hurricane forming and you could trade this like a live cat, isn't it? I mean,
Well, that's right.
You
That's
say,
right.
well, I'm
Yeah.
worried I'm going to buy this or sell it, whichever one, and I'm going to get capital relief if what I think is going to happen.
The other big theme, we've talked about it already, is really innovation. We have just gone past the pricing peak in the cycle. And what I remember from last time is that what became very, very important in this next phase of the cycle, particularly for intermediaries, but also underwriters, is to innovate. And it looks like that's happening. It looks like we're actually growing via exposure and doing so profitably now. But to continue to do so, we have to come up with new product. We have to come up with new structures that are more attractive to buyers, both at the cedent and policyholder level. And so product design is going to become incredibly important. And that's something that our analytical team here does every single day. And it's really interesting. It's the most interesting part of the job. So as the market moderates, that's going to become a much bigger theme.
In a hard market, you can just batten down the hatches, make money by doing a load of vanilla things. But when the market softens, you have to think of better product, something that's more really attuned to your client's need.
Absolutely.
You've got to work harder, basically.
And we will.
There's got to be give and take. You can't have a lovely vanilla layer and not get signed down if you're not offering some aggregate product or some more interesting, giving perhaps a bit more earnings protection than you would have liked to have given 2 years ago, just when you didn't need to do that kind of thing.
That's right. At Howden, we think about insurance and reinsurance as an enabler. It's an enabler of economic growth. It's an enabler of people in society. And we take this really seriously. We think that actually innovation and the ability to create cover, and particularly risk cover for people and for companies, is what helps the economy grow, and it couldn't grow without it. So in this next phase of the cycle, that's something that we're philosophically taking extremely seriously here. And it's one of the driving ambitions that we have, is to give our clients the cover they need at a good price while keeping our suppliers happy. I suppose that's the job of a broker at the end of the day.
That is the job. Well, good luck with the job. Yes, I think the work begins.
Andiamo.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.